In this video, I'm going to talk about the largest bank in the FTSE 100 and give my views on this bank stock, HSBA, and whether you should buy this stock right now. Don't forget to leave your suggestion for the next stock to be reviewed in the comment section down below and drop one of these for the YouTube algorithm. Please consider subscribing also, as 60% of you are not subscribed. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please see a licensed professional. HSBC, or Hong Kong Shanghai Banking Corporation, is a financial company listed on the London Stock Exchange but is globally diverse. HSBC have a multitude of different segments related to the financial industry. The most important ones that I can think of are retail banking, wealth management, and commercial banking. This effectively means they can offer a range of different products, ranging from savings accounts, credit cards, to investment management, and perhaps credit and lending towards more commercial businesses. I figured this stock would be very topical to choose due to the recent allegations of money laundering in the news. HSBC currently have 232,800 employees and a market capitalisation of £59 billion. As usual, the first statistic I like to look at to check how a company is valued is by looking at the price to earnings ratio. However, the price to earnings ratio is currently negative, suggesting to me that the HSBC is currently unprofitable. Although this is very understandable, as a lot of the banks are under a lot of pressure currently by the regulating authorities throughout the globe, and therefore they are encouraged to increase liquidity and therefore lend out more money to stimulate the economy. But this subsequently increases risk, and especially more bad loans that they won't make money back for, which potentially means that the reason they are unprofitable is the fact that they've written off bad loans and on paper unprofitable, but in reality could be fairly profitable. Although this is just my assumption, so I'm not 100% certain. However, what we can do is look at their market capitalization compared to their net assets, which gives us a price to book ratio. If it is less than 1, it means the business is undervalued based on their assets, and currently HSBC has a ratio of 0.4 times, suggesting to me that this stock is extremely undervalued compared to what it should be based on its assets. However, this could also mean that investors have priced in depreciating assets on their balance sheet, or that they have very low sentiment towards the business. And this is the same for the industry that also has 0.4 times, suggesting furthermore to me that the banking industry in general in the UK markets has not got high investor sentiment. I'm not surprised following the 2008 financial crisis and subsequently a period of uncertainty due to the pandemic. This could be considered a high value play, especially since considering this week HSBC hit their 25-year lows. I personally see this as a value play, but with a lot of risks priced in. But before talking about the risks, I'm going to look at their growth potential for the future. Although when looking at how effective a management is at generating returns, it doesn't look promising. Ideally, for a stock with long-term growth opportunities, you'll see companies that can generate high returns on equity, high returns on assets, and high returns on capital employed. Unfortunately for HSBC, this is not the case. Obviously, they are unprofitable, so they have a negative return on equity of minus 0.97% and a negative return on assets of minus 0.02%. Obviously, the negative earnings growth will impact these statistics, and the fact that they also do retail banking certainly would eat into their profit margins, as that's not where the profitability is located. However, the wealth management sector will likely be making up for this, and in fact, this is likely why they're only losing a small amount of money currently. Whilst yes, usually they had profit margins ranging from 20 to 26%, currently they're only down at a negative profit margin of 1.2%. And that's quite impressive, and you can really appreciate how resilient this is despite this time of uncertainty. Whilst in the last 5 years they have had negative growth on average of minus 6.3% each year, they did have previously more resilient profit margins. However, to be fair to the banking industry, since 2008, the financial crisis, it's very unlikely to see bank stocks as high growth plays. And furthermore, adding to this, I think it is very unfair that I did look at HSB from a growth perspective, as it is a very large and globally diverse company that has little to no growth potential, but does add value in paying dividends. So if you're not living under a rock, you will likely have known that the banks have suspended their dividends, and this was under regulatory pressure from the Bank of England and other European regulators. They effectively said that you need to cancel your dividends so that you can increase the amount of cash flow you have on your balance sheet, and therefore lend out more money and therefore increase liquidity and keep inflation under control. However, if we assume that these dividends were resumed in full, Prior to this, HSBC did have a higher than average yield. It is forecasted that they would have a yield currently of around 7.25%. This was a dividend that paid quarterly in the UK, which is fairly rare. They typically paid in April, July, September and November each and every year. Although what doesn't look too promising is when you look at their historical dividend cover, very similar to a payout ratio, you can see that in 2016 they had a dividend cover of 0.14, and that only went up to 1.26 in 2018, suggesting to me that they are unable to sustain their dividend payments, and in fact, in these years they were likely drawing upon their cash position in order to support it. This means that in the future, if the banks are given the green light for dividend payments, it feels to me that it's very unlikely that they will resume it at their previous payment prices, and therefore I believe that a cut is due. And until they can reverse their negative earnings growth trend, I do deem it fairly unlikely that they will be paying dividends. However, in the last 20 years, you can give them credit for paying a dividend each and every year, even if it wasn't necessarily grown upon each year. And so perhaps this puts a counter towards my argument saying that HSBC, despite being perhaps unprofitable, will likely still pay a dividend as they are confident in their future potential. So does this mean that HSBC has a strong balance sheet and therefore in future could draw upon their cash position to pay a dividend once the Bank of England gives them a green light? Well, HSBC has a good but not great balance sheet. Their short-term assets do not outweigh their short-term liabilities, but they do outweigh their long-term liabilities. However, this is fairly typical for a financial company, and it is expected for them to have much higher debt loads. Typically, their liabilities are actually low-risk liabilities such as customer deposits, and so it isn't as bad as it looks. So the best thing we can look at to judge the balance sheet is their debt-to-equity ratio. Currently, they have a debt-to-equity ratio of 361.7%. And this does look concerning to potential investors, as their debt pretty much triples their total equity. However, we need to look at the importance of their cash position, and in which their cash position actually takes up more than their debt and equity combined, meaning that this company isn't going to go bust anytime soon, and nor should it. And the fact that they nearly have a $1 trillion cash position does put them in a strong position, although this could be due to regulations, and this cash may be there for emergencies, and therefore they may not be able to use this to pay a dividend. HSB, however, is a company that I would deem to have some significant risk priced into the share price, and something that could really demolish your shareholder returns. But this could also mean it is a good buying opportunity, but I'll talk about that later on. Firstly, HSBC is stuck in the middle of the US-China trade war. HSBC has a lot of their businesses located in China and the US, and especially Hong Kong. Hong Kong is a region in which there is a lot of political tension about. This is because a new rule which was heavily protested in Hong Kong actually went through, and this potentially gives China the power to reset their system. And in 1997, China created a one country, two systems rule, where they are communist, but Hong Kong can remain capitalist society. However, they have the potential, or they have the ability to reset this. This has a lot of geopolitical tension, and this means that the UK has also gotten involved. As you may have seen, Boris Johnson offering 3 million refugees citizenship in the UK, a similar thing applies. However, if China aren't too happy with this, they could potentially use HSBC as leverage, as this effectively could lead them to having leverage against Hong Kong and the UK, putting it in a very tricky trade negotiation spot. Another risk, obviously, as we have ongoing and affects pretty much every company, is the pandemic and the uncertainty it brings. However, banks are in possibly the worst positions than other businesses. Sure, they're very resilient, they have excellent balance sheets, the majority of them, and it's very unlikely they will get bust without a bailout. However, they are forced to pretty much deploy their cash and give away bad loans. This means that their balance sheet will be slowly deteriorating the longer the pandemic is. And if this pandemic goes on for a while, this means it could take even more years for these banks to recover. And they are effectively forced to support the economy and don't really have any say against or for it. The biggest ongoing risk, however, with HSBC is the ongoing money laundering scandal. This was something that they were fined by in the United States for $1.92 billion. Effectively, they had been caught for letting cash flow of illegal scamming money through their bank accounts, and whilst flagging it up, they didn't do anything about it. And whilst on probation of this fine, it has happened again. And such that what they were doing is they were profiteering off of a Ponzi scheme, effectively meaning that they were making money off of these illegal transactions by not blocking them. Rather than freezing the accounts, they were reporting SARS but weren't doing anything about them. So this even further means that they were making money from an illegal scammer's set of money, and quite a significant amount out of that too. This puts HSBC in a very precarious position, as this could mean that the US could say, you know what, we do not trust HSBC anymore, we are going to make you sell this to JP Morgan, for instance. And if they become an illegitimate banking lender in any major economic developed area, such as the EU, even China, this could seriously devastate the stock price and the company. However, the issues with money laundering and the fact that interest rates, in my own personal opinion, will remain low for the next 10 years at least, puts HSBC in a very weak position. I personally do not like the risks and exposures behind HSBC. And so long as there's some geopolitical tension, since HSBC is such a globally diverse company, it's very likely they're going to somehow be caught in the middle of it. And I believe that countries could use this as political leverage and effectively mean that they could hit other economies by denying this. An example would be China, for instance, banning certain technologies in their ecosystem. Very much same could apply if they decide, you know what, we no longer want HSBC in our country. And that significantly impacts the business, which could impact the UK's overall GDP, for example. However, this also could potentially present an amazing buying opportunity. As the famous saying goes, buy when there's blood on the streets. Right now, there's so many risks joining together and compounding. This could mean that this is an excellent value opportunity if you're looking for a recovery play. And perhaps you believe that these risks will dissolve. If you'd have bought HSBA stock 5 years ago, you would have gotten returns of minus 25.2% with dividends reinvested versus the UK market of 21%. One important thing I will mention if you are considering buying stocks of HSBA is that I would seriously stress the idea of cost averaging into this stock. I say this a lot, but this is a company's share price that could potentially go a lot further down and has been downtrending for the last few years. So be careful, do your own research, and if you're interested in my National Express stock analysis, click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.